We are interrupting regular programming with a major development in global trade and climate economics. Moments ago, the Canadian Ministry of Natural Resources, in a coordinated move with the Quebec provincial government, announced an immediate and unprecedented price increase for all exports of its certified green aluminum. This is not a market adjustment. It is a sovereign policy shock. A mandatory green integrity surcharge of 35% has been activated. The target is explicit: multinational corporations who have built sustainability marketing on the back of Canada's clean energy. Front and center in the crosshairs are beverage giants Coca-Cola and PepsiCo. Their global supply chains, dependent on billions of low-carbon cans, have just been thrown into disarray. This decision, delivered without warning, represents a fundamental shift in the relationship between resource nations and consumer empires. Canada is wielding its environmental advantage as a strategic weapon. The implications are staggering, threatening profit margins, brand reputations, and the very premise of cheap, green consumption. We have confirmation that senior executives at both Coca-Cola and PepsiCo were given precisely 30 minutes' notice via secure diplomatic channels before the public release. This was a deliberate ambush. The stated rationale from Ottawa is the true valuation of carbon-free industrial production. The unstated message is far sharper. The era of taking Canada's clean resources for granted is over. The context is critical. Over 90% of Quebec's aluminum production is powered by renewable hydroelectricity, giving it a carbon footprint per ton that is a fraction of metal from China, the Middle East, or even Russia. This green aluminum has become the gold standard for corporations making net zero pledges. They have loudly advertised their use of Canadian metal. Now, Canada is presenting the invoice. The surcharge is not a tariff. It is a unilaterally imposed premium, a new cost of doing business for any company wishing to purchase the certified sustainable product. It functions as a carbon border adjustment in reverse, applied not to dirty imports, but to clean exports. The economic calculus for Coke and Pepsi is now a nightmare. Initial estimates suggest this could add over $250 million in annual input costs for each company. In the low-margin, high-volume world of canned beverages, this is catastrophic. There are no easy alternatives. Switching to standard, coal-powered aluminum would violate their publicly stated environmental goals and ignite a firestorm of activist and consumer backlash. They're trapped. The political architecture behind this move is sophisticated and reveals a deep-seated frustration. For years, Canadian officials have watched multinationals tout their use of green Canadian aluminum in annual sustainability reports while simultaneously pressuring smelters on price during contract negotiations. The resource was being used as a cheap marketing prop. Today's surcharge reframes it as a premium product, worthy of a premium price. The operational mechanics were shrouded in secrecy. The policy was drafted under the working title, Project True North. Only a handful of deputy ministers and the Prime Minister's inner circle were involved. The legal basis leverages existing export control frameworks, amended at midnight to include the green integrity surcharge as a condition of sale for metal from designated hydro-powered smelters. The Canadian Border Services Agency received the updated digital directive simultaneously with the public announcement. This was a perfectly executed digital policy strike. The immediate market reaction has been chaos. Trading on aluminum futures is volatile, with a specific contract for North American primary metals spiking. More tellingly, shares in both Coca-Cola and PepsiCo are down sharply in pre-market trading. The shock is radiating through the entire consumer packaged goods sector. Companies producing canned soups, beers, and prepared foods are now on high alert, scrambling to assess their own exposure. The geopolitical dimension is explosive. This is a direct challenge to the United States, the primary consumer of Canadian aluminum. The U.S. automotive and aerospace industries also rely on this metal. While the initial focus is on beverage cans, the precedent is set. Washington will see this as a hostile economic act from its closest ally. Diplomatic cables are flying between Ottawa and Washington at this moment. The historical backdrop adds layers of intrigue. The Canadian aluminum industry, centered in Quebec, was born from a grand national project, the development of massive hydroelectric complexes in the mid-20th century. It symbolizes a covenant between the state, the people, and the land. The feeling in Quebec City and Ottawa is that foreign corporations have benefited from this legacy without honoring its true value. This surcharge is framed as a corrective, a reclamation of that value for the Canadian public. For the workers in the Saguenay, Lac-Saint-Jean region, the heart of the industry, reactions are mixed. There is pride in the world finally paying a fair price for their clean work. But there is also profound anxiety that buyers will simply walk away, idling the smelters. The government's pledge is that the surcharge revenue will be reinvested into a sovereign wealth fund for the green transition and direct support for smelter communities. It is a high-stakes gamble on the indispensability of their product. Inside the corporate war rooms of Atlanta and Purchase, New York, crisis protocols have been activated. The first priority is supply chain triage. How much physical aluminum is already in their pipeline? How long can they maintain production before confronting the new price? Estimates suggest a runway of 6 to 8 weeks. After that, the choice is brutal: pay the premium, switch suppliers, or face can shortages. The second priority is legal. Teams of international trade lawyers are examining the USMCA and WTO rules. They will argue this is a discriminatory export duty, illegal under trade law. Canada will counter that it is a legitimate environmental measure, a fee for an audited, certified ecological service, the provision of carbon-free material. The legal battle will be epic, but it will be fought over years. The market disruption is happening now. The third, and perhaps most critical, priority is public relations. Both companies have staked their reputations on sustainability. Coca-Cola's World Without Waste and PepsiCo's PepsiCo Positive campaigns are centerpieces of their brand identity. They now face an impossible narrative. If they absorb the cost, they must explain falling profits to shareholders. If they pass it to consumers, they risk backlash during a period of persistent inflation. If they fight Canada, they look like climate villains. If they switch to dirty aluminum, they are exposed as hypocrites. Canada has masterfully engineered a catch-22. The surcharge also exposes a raw nerve in the global climate movement. Who should profit from the green transition? Historically, the financial benefits of sustainability have accrued to brand-name corporations who market green products and to end consumers. The primary producers of the clean materials, the nations mining the lithium, refining the nickel, or smelting the aluminum with clean energy, have often seen minimal premium. Canada is demanding a redistribution of that green premium. This is a declaration of resource sovereignty for the climate age. The ripple effects are instantaneous. Other resource-rich nations with low-carbon profiles are watching closely. Norway, with its hydro-powered industries. Australia, with its potential for solar-powered critical mineral processing. Chile, with its green lithium. The Canadian model could become a template, leading to a wave of similar sovereign price adjustments. This would permanently alter global trade, creating a two-tier system of commodity prices, one for dirty and one for clean. The inflationary pressure across countless consumer goods would be profound. The beverage giants are not without recourse, but their options are perilous. They could attempt to form a buyer's cartel, a unified front to refuse the surcharge. But antitrust laws make this difficult, and the competitive tension between Coke and Pepsi is legendary. One might break ranks to secure supply and gain a marketing edge. They could accelerate investments in recycling and closed-loop systems to reduce virgin aluminum demand, but that is a long-term strategy. They could seek to politically pressure the U.S. administration to intervene, framing Canada's move as a threat to American jobs and consumers. The human element is stark. For a family budgeting for groceries, this may soon translate to a few more cents for a 12-pack of soda. The question is whether they will connect that price to climate policy or simply blame corporate greed. Canada's move effectively makes the abstract cost of carbon concrete at the checkout aisle. It is a brutal, real-world economics lesson. The strategic genius of the move lies in its timing. It comes amid heightened consumer awareness of greenwashing. Activists are more savvy, scrutinizing corporate claims. By forcing Coke and Pepsi's hand, Canada is exposing the soft underbelly of corporate sustainability. It is often built on affordable, clean inputs that are taken for granted. The coming weeks will be a masterclass in crisis management. We will see press releases, carefully worded commitments, and likely a flurry of behind-the-scenes summitry. An emergency meeting of the USMCA Free Trade Commission is already being discussed. The European Union, itself rolling out its own carbon border adjustment mechanism, will be watching with academic interest, seeing a test case for valuing embedded carbon. The suspense is palpable. Which corporation will move first? Will there be a joint lawsuit? Will the U.S. government threaten retaliatory measures? The stability of the North American industrial base is now in question. Automotive manufacturers are running the numbers, fearful they are next. The ultimate outcome may redefine value in the global economy. It pits short-term shareholder interest against long-term planetary investment. It asks whether environmental stewardship has a market price that producers can dictate. Canada, with its vast rivers and clean grids, has decided it does. And it has sent the invoice to the world's most recognizable brands. As the sun rises on this new economic reality, one truth is inescapable. The rules of the game have changed. The transition to a green economy will not be a smooth, consensual process. It will be punctuated by raw displays of power, economic standoffs, and brutal renegotiations of value. Canada has just fired the opening shot in the battle over who profits from saving the planet. And the reverberations will be felt in boardrooms and shopping carts around the globe. The pressure on Coca-Cola and PepsiCo is now immense, a perfect storm of financial, reputational, and operational risk. Their next move will be historic. The world is watching.